Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss trading the spread, Bitcoin ETF versus crypto stocks ETF.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. So what is the topic for today? Today we will discuss cryptocurrency pair trading. Firstly we will define what the pair trading is, and then we will discuss the strategy itself. So firstly, what is the pair trading? So in the pair trading you try to find two or more assets that are moving very closely to each other, so they are highly correlated. You are trying to build a spread between those two assets, and you are buying the asset that's cheap and shorting the asset that's expensive when the spread is too wide, and you hope that the spread will get more narrow. So that's basically how the pair trading strategy is done. You can do the pair trading on stocks, you can do the pair trading on cryptocurrencies, commodities, fixed income, futures, etc. etc. So once you have the market which is really liquid, you do not have a problem to find assets that are correlated or which moves close to each other. Okay, so what we will discuss is how to trade the spread or how to trade the pairs, and we are not using the cryptocurrencies itself. We will trade the spread between Bitcoin ETF and the cryptocurrency infrastructure ETF. Yeah, the Bitcoin ETFs are simple. There are a lot of them at the moment. So we have a spot Bitcoin ETFs like IBIT, etc. etc. In this strategy or in this backtest, we used the BITO. The reason for that is because it starts sooner than the spot ETF. The spot ETF started in 2024. On the other hand, the BITO ETF started in 2021. So we have a longer backtest, we have a longer trading period. That's one part of the pair. And the second part of the pair is the crypto infrastructure ETF. What is the crypto infrastructure ETF? So before the Bitcoin future ETFs or Bitcoin spot ETFs started to be prevalent in the market, investors started to use other types of the ETFs, and those ETFs were the cryptocurrency infrastructure ETFs. So those were the ETFs that both companies had the main business line of serving the cryptocurrency customers. So you have the ETF that buys the cryptocurrency exchange stocks, blockchain stocks, semiconductor stocks, etc. etc. So basically the companies that are serving the cryptocurrency infrastructures pull all those companies into the ETF, and you can buy that ETF. I mean, those ETFs are older than the spot ETFs or than the future ETFs or cryptocurrency ETFs itself. So we have a long history of the data. And of course, because those companies in those infrastructure ETFs, they serve the cryptocurrency market, their performance is very highly correlated to cryptocurrency market itself. So it's a very great target for pair trading. So we have those two ETFs, the Bitcoin ETF and the infrastructure ETF, and from those two we will build the spread. How can we construct the spread? To construct the spread, it's usually better to select an asset with a higher return or higher beta for a long position and hedge it with a lower yielding asset by creating a short position. When we have two assets available, the higher beta is usually more profitable, and lower beta, less volatile asset is one that's suited for the long leg of the spread. So that's usually how we build the spread. So in our case, we use the Bitcoin ETF or Bitcoin futures ETF, BITO, for a long position, and the block ETF, which is a cryptocurrency infrastructure ETF, for the short position. The rationale for this setup is that the price of the companies providing infrastructure is related to the Bitcoin and is correlated to the price, but it's not exclusively driven by it, so it has a lower beta. We actually ran the calculation, and the block has a lower beta than the BITO ETF, compared to the Bitcoin. Now the question is how to build the spread. How much of the ETF should be put into long and how much to the short position. So there are basically two ways. The first one is the dollar neutral, and the second one is the beta neutral. So the dollar neutral is that you will long the same amount of the ETF as you short. So in our case, we will go long 100% of the BITO ETF and 100% short position in the block ETF. So that's dollar to dollar, but you can have also the beta neutral spread, and in this case you will calculate what is the beta of the one ETF and the second ETF, and you will adjust the spread. So it means in our case, for example, we should have 100% long position in the block ETF and 93% position in the BITO ETF, and in this case we will have the beta neutral position. But we are using the dollar neutral because it's easier, and there is no big difference between the beta of the block and the BITO, so it's easier to do the dollar neutral. But also that's the reason why we have the BITO ETF in the long leg and the block ETF in the short leg. Okay, the quick word about the total portfolio leverage. So our maximal position in the spread will be 100% long BITO and 100% short the block. So what does it mean is that our total portfolio leverage doesn't exceed 200%. and this allows us to easily hold overnight positions in the spread, because for the most of the margin accounts offered by regulated brokers offer this leverage, very easily. Final consideration is the shorting cost. When you short ETF, you must pay the shorting cost, and we are approximating those shorting costs by using the Ameribor rates during that period. Okay, how does the spread look like? So as we can see, the spread moves down, up, but plus or minus moves around zero performance. So when you long one ETF, short another ETF, you have the dollar neutral portfolio. At the end, you are just jumping around the average. When we take a look on the chart a little, we can see a small trend, but small trend disappear when we remove, I don't know, last 3 months of the data or something like that. So the trend in the data is highly dependent on the time window, so we can have the hypothesis that the spread is zero. If you would like to remove the spread completely, then it's better to use the beta neutral portfolio. So it means going long just 93% of the ITO and short 100% of the block, and in this case you will have the completely flat spread. So what is the trading strategy or trading rules that we will use? So in this case, we are inspired by our previous article, how to build mean reversion strategies in currencies. If you are interested, we discussed this article in a video maybe 2 months ago, plus or minus. So what is the strategy about? So you build the spread and you are buying the currencies that are far below the spread, and you are shorting the currencies that are far above the spread. In this case, we used 7 currencies, and here we are using only the 2 ETFs. So what does it mean is that we will measure how far away we are from the zero line of the spread, and if we are below the zero line, we will buy more and more of the spread, and as we move on the other side, we will sell spread and we will go short when we are too far away on top or over the spread. So in the linear strategy, for instance, if the equity curve is 20% below zero, so if the spread is 20% below zero, so something like here, we will establish a 20% long position in the spread for a day or for a month. And on the other hand, if the equity curve is 20% above zero, so for example like here, we will short, and our position will be 20% short position. So as far away as you are from the spread, that's your position. If you are too far away, you have the high position. If you are on the other hand too far away below, you have the high long position in the spread. So when you have a long position in the spread, what does it mean? You go long the BITO and you short the block. If you go short spread, you go long the block and the short BITO. So you just reverse the position. That's the linear trading strategy, and then we can have an exponential trading strategy. What is the exponential? It follows the similar principle but greater degree of leverage. So if the equity curve is 20% below the zero line, we open 40% long position. And for example, if it's 30% below, we will open 90%. If it's 40% below, we will open 160. So what does it mean is, as more as you go under the curve, the higher your position will be, but not in the linear fashion, but in exponential fashion. Of course, this exponential position sizing has a higher risk compared to the linear strategy, but you can have higher returns. But we already discussed the risk in the previous article. When you set up the leverage correctly and in a clever way, you can have a higher performance and do not increase the risk too much. Then what is the rebalancing period? So we can rebalance on a daily basis, or we can rebalance our portfolio on a monthly basis. So this is how does it look like if we rebalance on a daily basis. So here we have equity curves of the exponential and linear strategy when we trade the spread. Just the long positions, here are the short position, and here is the long short strategy. Here we can see that when you use the exponential strategy, you have usually higher performance, and also probably the higher return to risk ratios, because the performance is usually higher than the risk do entail. Because we are not using the whole leverage that we can, because maximally we are long plus or minus 30% of the spread, and we are short approximately minus 30% of the spread. So we can leverage those strategies, and we can use approximately 3-to-1 leverage for the linear strategy. For the exponential, we cannot use so much leverage. So when we leverage the linear strategy, it has approximately the same performance as the exponential. So you can use the leveraged linear position sizing, or you can use the exponential position sizing, and in the end you have plus or minus the same performance. How does it look like with the monthly rebalancing? So one of the reasons why we backtested also the monthly rebalancing is to avoid the costs that are connected with rebalancing the portfolio on a daily basis, because when you rebalance portfolio on a daily basis, you incur the trading fees and the slippage, etc., etc. So when you do it once in a month, it's significantly better. So once again, we have a linear exponential strategy, just going the long spread. Here we just go the short of the spread. Here is the mixed strategy. Here we have same strategy but with using the leverage. The long short strategy has a performance around 5%, a standard deviation around 10%, maximum drawdown around 11%, so Sharpe ratio around 0.6, which is not bad. Just using the two ETFs, having the Sharpe ratio 0.6 is pretty fine. Of course, the long positions has a better Sharpe ratio, but you do not need to just use the long positions, but usually you go the long and short positions too. Or you have the long leg and short leg too, and you mix them together. What are the ways how to improve this strategy? Of course, the easiest way is to include more ETFs. So that's the easiest way. We just use the 2 ETFs. You can make a pool of ETFs, I don't know, 20, and you can find multiple pairs, you can trade multiple pairs, you will have a like smoother equity curve, better performance, you can use higher leverage. So it's very similar to how we built the strategy in the currencies, but I mean in this case we just picked the two, so because we wanted to show you how does it work when you have just two strategies. Of course you can use some more sophisticated ways how to do the position sizing. Of course you can use more sophisticated ways how to calculate the spread, so not just the dollar neutral spread, you can use the beta neutral, then you can use some copula, etc. Other more sophisticated ways how to calculate the spread, how to balance the assets in the long and short. But if you want to get deeper into that, I really recommend you to go through Quantpedia strategy that we have in our subscription, because they go deeper and deeper into this kind of the strategy. So this is just a very simple example how does it look like. But you can easily trade this simple, very simple strategy, which is like market neutral. Okay, thank you very much. I hope that you like this video. I hope that you like this very simple example how the pair trading or spread trading look like, especially when you want to pair trade or spread trade the cryptocurrencies using the ETFs. So give us if you like the video, subscribe to our channel, visit our webpage, you can follow us on our social media, and I hope that you will join me in the next video. And thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.